Understanding fraud. This video will explore one of the most significant challenges affecting individuals, businesses, and the entire economy, fraud. It will define what fraud is, walk through its different types and the underlying psychology behind fraudulent behavior, learn how to spot its red flags, and then look at what steps can be taken to combat and prevent fraud. Finally, it will review the legal framework that governs fraud in the UK and consider emerging trends in this ever-evolving landscape. Defining fraud, what is it? Definition and core concepts. What is fraud? Fraud is the intentional act of deception designed to secure an unfair or unlawful gain, or to cause a loss to another party. Legally, fraud involves misrepresentation or concealment of important information with the intent of personal gain or to inflict loss. Core elements. Fraud usually involves three key components. Deception. The act of misleading by false or incomplete representations. Misrepresentation. Presenting information that is knowingly untrue or misleading. Intent. The deliberate purpose to gain an advantage or cause harm. Types of fraud. Financial fraud. This category includes scams such as investment fraud, mortgage fraud, insurance fraud, and credit card fraud, where victims or organizations are misled to part with money or assets. Cyber fraud. In today's digital age, fraudsters use tactics such as phishing, malware attacks, ransomware, and various online scams to deceive victims. Identity theft. Fraudsters steal personal information, such as social security numbers, bank account details, or credit card information, to assume someone else's identity and commit further fraud. Internal fraud. This occurs when employees or insiders exploit their trusted positions to defraud their own organizations through activities like embezzlement or misappropriation of funds. Procurement fraud. Fraud related to the purchasing process, such as falsifying invoices, kickbacks, or collusion between vendors and insiders, can inflate costs and skew competitive bids. Benefit fraud. Illegally claiming state benefits or insurance payouts by providing false information falls under this type of fraud. The fraud triangle. To help understand why fraud happens, we often refer to the fraud triangle. There are three elements. Opportunity. Weak internal controls or oversight provide the chance to commit fraud. Motivation or pressure. Financial pressures or other personal incentives can drive someone to commit fraud. Rationalization. The fraudster's process of justifying their behavior, convincing themselves that the act is acceptable or that everyone does it. By understanding these basic definitions and categories, we can begin to appreciate the complexity of fraud and how it manifests in various settings. Spotting the signs, red flags of fraud. Behavioral red flags. Suspicious behavior. Individuals who suddenly exhibit changes in their lifestyle, such as appearing wealthier than their means, or who become unusually secretive or defensive about financial matters may be exhibiting warning signs of fraud. Documentary red flags. Irregularities in documentation. Look out for missing, altered, or inconsistent documents. For example, invoices that don't match up with purchase orders or financial records that contain unexplained discrepancies can indicate fraudulent activities. Systemic red flags. Process anomalies. Fraud can also be embedded in the processes of an organization. Unusual transaction patterns, unauthorized access attempts in financial systems, or a breakdown in internal controls are systemic red flags that warrant further scrutiny. Cyber red flags. Digital indicators. In a world increasingly dependent on technology, be wary of suspicious emails, unusual website addresses, and unexpected software installations. These signs may indicate cyber fraud attempts like phishing attacks or ransomware infiltrations. Observing these red flags early can be crucial. Whether it's an employee's behavior or discrepancies in financial records, recognizing these clues helps organizations take swift action to investigate and mitigate fraud. Taking action, combating fraud. Reporting procedures. Internal and external reporting. It's vital to have clear procedures so that when fraud is suspected, it can be reported internally through designated channels and externally when necessary, for example, via action fraud or local law enforcement. Investigation basics. Evidence gathering. A solid investigation depends on the careful collection and preservation of evidence, whether physical documents, digital logs, or eyewitness accounts. Early involvement of forensic experts can help preserve the chain of custody for evidence. Working with law enforcement. When to call in the authorities. If internal mechanisms uncover potential fraud, and depending on its scale or complexity, it may be necessary to involve the police or relevant regulatory bodies. This external support ensures a thorough investigation and often facilitates the recovery of stolen assets. Internal disciplinary actions. Addressing insider fraud. Organizations must have defined disciplinary processes. When an employee is suspected or found to be involved in fraudulent behavior, swift internal action, including suspension or termination and potential legal recovery, is crucial. Recovery of losses. Asset recovery strategies. Whether through insurance claims, legal actions, or internal compensatory processes, recovering losses is an essential part of the response to fraud. Establishing contingency plans ahead of time can improve recovery timelines. Ethical considerations. Upholding integrity. Throughout the process, from investigation to recovery, it's important to maintain ethical standards. Protecting the rights of those involved and ensuring confidentiality can help prevent further damage and preserve trust within an organization. Taking decisive actions as soon as fraud is suspected not only stops further losses but also sends a strong message about the organization's commitment to integrity. Building defenses, fraud prevention strategies. Strong internal controls. Robust policies and procedures. Implementing clear policies that govern financial transactions and operational processes is essential. For example, segregation of duties. No single individual should control all aspects of a financial transaction. Dividing responsibilities minimizes the risk of any one person committing fraud. Authorization limits. Establish clear thresholds for approvals so that significant transactions require multiple layers of verification. Regular audits. Frequent internal and external audits help detect irregularities early and ensure compliance with established controls. Due diligence. Pre-engagement checks. Conducting thorough background checks on potential partners, vendors, and employees can significantly lower the risk of falling prey to fraud. Employee training and awareness. Education programs. Regular training sessions help employees recognize common fraud schemes, understand red flags, and know the correct procedures for reporting suspicious activity. Technological safeguards. Digital defenses. Use state-of-the-art technology, including firewalls, intrusion detection systems, and data analytics, to monitor transactions and flag anomalies. These systems can detect patterns that may indicate fraudulent behavior before it escalates. Physical security measures. Asset protection. Beyond digital safeguards, physical measures such as secure storage for records and controlled access to critical areas also contribute to fraud prevention. Risk assessments. Ongoing analysis. Regularly assessing the organization's exposure to fraud allows for the timely updating of policies and the introduction of new preventive measures. This proactive approach is key to staying ahead of increasingly sophisticated fraud schemes. Combining these strategies creates a formidable defense against fraud, protecting not only financial assets but also the reputation and integrity of an organization. The legal framework, UK laws and regulations on fraud. The Fraud Act 2006. Overview. Enacted in December 2006 and coming into force in January 2007, the Fraud Act 2006 modernized the law by simplifying fraud offences. This act covers fraud by false representation, fraud by failing to disclose information, and fraud by abuse of position. Impact: it allows for more straightforward prosecutions and stricter penalties, making it easier to hold both individuals and organizations accountable. The Proceeds of Crime Act 2002, POCR. Purpose: POCR focuses on money laundering and the recovery of assets obtained through criminal activity. This essential piece of legislation acts as a deterrent by providing law enforcement with the power to confiscate ill-gotten gains. The Bribery Act 2010. Relevance: while primarily aimed at combating bribery, the Bribery Act is intertwined with fraud prevention because corrupt practices often underpin fraudulent activities. It establishes robust guidelines and significant penalties for organizations that fail to prevent bribery. The Computer Misuse Act 1990. Cybercrime focus. Given today's digital environment, this act is crucial for addressing cyber fraud. It criminalizes unauthorized access to computer systems, a foundation for prosecuting online scams and data theft. Other relevant legislation. Laws such as the Theft Act 1968 and the Forgery and Counterfeiting Act 1981, along with various data protection regulations, also play important roles in the legal landscape. Regulatory bodies. Serious Fraud Office, SFO, and National Crime Agency, NCA. These organizations investigate and prosecute high-level fraud cases. Action Fraud. Serving as the National Reporting Center for Fraud and Cybercrime. Financial Conduct Authority, FCA, and local police forces. They work to enforce fraud-related regulations and assist in prosecution at various levels. Understanding the legal framework and the roles these agencies play is fundamental to both preventing and prosecuting fraud in the UK. The evolving landscape of fraud. Emerging trends. New fraud schemes. Fraudsters are constantly innovating. Today we see emerging forms of fraud such as cryptocurrency scams, AI-driven fraud, and sophisticated social engineering attacks. Impact of technology. While technology can create new vulnerabilities, it also offers advanced tools for detection and prevention. Data analytics, machine learning models, and real-time monitoring systems are increasingly critical in identifying unusual patterns and stopping fraud before it escalates. Changes in legislation and regulation. Evolving laws. Recent amendments and ongoing discussions in the UK are addressing digital assets and online fraud. These changes have a significant impact on how fraud is detected, prosecuted, and prevented. International cooperation. In our globalized economy, fraud often transcends borders. International partnerships and information sharing are key components in tackling transnational fraud. Staying abreast of these developments is essential for adapting internal controls and ensuring that both individuals and organizations remain protected against evolving fraud threats. The impact of fraud, consequences and costs. Financial impact. Economic costs. Fraud imposes enormous financial costs on individuals, businesses, and the overall economy. Whether through direct monetary losses, increased costs of doing business, or higher insurance premiums, the financial repercussions are significant. Reputational damage. Trust and image. Fraud not only affects the bottom line but also erodes trust. Organizations embroiled in fraudulent activities can suffer long-lasting reputational damage that affects customer confidence and market positioning. Emotional and psychological impact. Personal toll. Victims of fraud may suffer from stress, anxiety, and long-term psychological trauma. The experience of being deceived can affect personal relationships and overall well-being. Social impact. Wider consequences. On a societal level, fraud contributes to economic inefficiencies and can undermine public confidence in institutions. Increased costs in goods and services, diminished investor confidence, and higher regulatory scrutiny are all part of the broader impact. The far-reaching consequences of fraud underscore why it is so essential to have effective preventive and reactive measures in place. In summary, fraud is a multifaceted and ever-evolving challenge that involves deliberate deception and misrepresentation for personal gain or to cause harm. Today we explore the defining elements of fraud, the various types, from financial and cyber fraud to identity theft and internal fraud, and the concept of the fraud triangle. We also examined the red flags that signal fraudulent activity, the steps organizations and individuals can take to combat and investigate fraud, and the strategies needed to build robust defenses. We then delved into the legal framework in the UK, from the Fraud Act 2006 and Poker 2002 to the Bribery Act 2010 and Computer Misuse Act 1990, as well as the role of agencies such as the SFO, NCA, and Action Fraud. In today's digital age, emerging trends like cryptocurrency scams and AI-driven fraud remind us that vigilance and adaptability are key. The impact of fraud is profound. It drains financial resources, damages reputations, and takes an emotional toll on individuals, all of which stress the importance of a proactive, ethical, and well-regulated approach to combating fraud.